This is the start of the advanced section for technical analysis. The concepts you will learn in this lesson are much harder than what we've covered in the previous two technical analysis sections, with the technical analysis basic and technical analysis intermediate. It builds on those ideas, but has a twist with complex ideas. As a new trader, you won't use many of these ideas, but as you improve and develop as a trader, I would advise you come back to these lessons because they can help you a lot. I use many of these strategies, and I'll tell you what ones I do use and I don't use as we go through these lessons. The first lesson is what are pivot points? And the learning objectives are you should know how to calculate pivot points and you should know how to use pivot points. Pivot points are used to determine potential turning points in the price action. It is one of the most commonly used indicators for identifying support and resistance levels and gauging bullish and bearish market sentiment. Pivot points are objective, and because so many people are looking at these levels, they almost become self-fulfilling. There are multiple types of Forex pivot points, including floor pivot points, also known as standard or classical pivots, and they use a special formula to identify support and resistance levels. There are also Fibonacci pivot points, and these use important Fibonacci levels to determine where support or resistance is located. There's also Camarilla pivot points, and this is a math-based leading indicator that provides accurate and automated levels of support and resistance levels. The Camarilla points contain one central pivot point along with 4 levels of support and 4 levels of resistance. There's also Tom DeMark's pivot points, and this focuses on the most recent data to identify potential turning points. And there are also Woody pivot points, and these are calculated from past price points. Most use a variation of significant prices, such as established highs, lows, opening and closing prices, and then apply a calculation to determine these points. They all calculate additional support and resistance levels alongside the pivot points. They can be used to determine when to enter or exit trades or to determine the range of a market. I would advise you do your own research on Camarilla pivot points and Tom DeMark's pivot points because they're not really relevant, they're just a variation of the main one that we're going to be looking at over the next few lessons. As with all other indicators, you should know the formula behind the standard floor pivot points. And it's very simple. The pivot point, which will be represented in many charts as PP, is equal to the high plus low plus close divided by 3. If you look at the daily time frame, it would be the daily high, the daily low, and the daily close divided by 3. The main pivot point is the central pivot point based on which all other pivot levels are calculated. Because the formula for the support and resistance pivots is support 1 is equal to PP pivot point, that's the main pivot point, times 2 minus high. Support 2 or S2 is equal to PP minus high minus low. Resistance 1 or R1 is PP times 2 minus the low, and then resistance 2 or R2 is PP plus high minus low. Usually, if we are trading above the central pivot point, this is a signal of a bullish trend. And if the price is trading below the central pivot point, it is considered to be a bearish signal. Most charting software will automatically calculate the pivot points for you. Just make sure you configure your settings so that it uses the correct closing time and price. Or tweak it to your liking to increase the sensitivity of it. And to suit it to your own trading strategy. Since the price levels are based on the high and low and close on the previous day, the wider the range these values, the greater the distance between the levels on the subsequent trading day. Likewise, the smaller the trading range, the lower the distance between levels will be in the following day. There are different uses for pivot points. Pivot points have the advantage of being a leading indicator, meaning traders can use the indicator to gauge potential turning points in the market ahead of time. They can either act as trade entry targets themselves by using them as support or resistance, or as levels for stop losses and or take profit levels. In conclusion, as with all indicators, pivot points should not be used as the only thing that you're basing your trades on. They should be used in addition with other technical indicators.